Canadian National Railway stock has been sliding, but analysts say it could rebound 20% by 2026. Is this a golden buying opportunity or a trap? Let's break it down. Hey everyone, welcome back to the channel. Today we're diving into CNR, Canadian National Railway. Current price? 133.83 Canadian dollars. Dividend yield? 2.65%. And the big question, is this stock a buy, sell, or hold heading into 2026? CNR is a blue-chip rail giant with a coast-to-coast network. It moves everything from grain and autos to energy and consumer goods. That's why it's considered an essential backbone of the Canadian economy. The market cap sits at 82 billion CAD, PE ratio around 18, showing it's not cheap but not outrageous. Institutional investors hold over 70%, which signals confidence. And don't forget, steady dividend growth plus buybacks makes this a long-term income machine. But it's not all smooth tracks. Shares are down 10 to 15% year-to-date, underperforming the TSX. Freight demand is uneven, especially with trade uncertainty. And valuation is a sticking point. Some analysts say it's fairly priced, not undervalued. So, if you're chasing growth, this might feel like dead weight. On the flip side, expansion projects like Prince Rupert could drive double-digit growth in intermodal volumes. Analysts expect EPIs to grow around 9% annually, with ROE hitting 22% in 3 years. That's strong. And consensus price targets range from 150 to 162 CAD, which is about 15 to 20% upside. So, here's the forecast. Bullish analysts see CNR climbing to 162 CAD within 12 months. Bearish technical models warn it could slip back to 126 Canadian dollars. Long-term, by 2026, dividend compounding plus freight recovery could push it well above 160 Canadian dollars. Bottom line, dividend investors will love the stability. Growth chasers? You might want to wait for clearer momentum. So, is CNR a buy or a bail? For steady dividend portfolios, it's a keeper.